Good afternoon and welcome once again to Digital Look TV. Joining us today is Mike Kerley. He is Director of Pan-Asian Equities at Henderson Global Investors. Mike, good afternoon. Thank you very much for joining us.
Good afternoon.
Okay, yesterday we had quite a bombshell from the U.S. Federal Reserve. Contrary to market participants' expectations, they decided not to move. Are we looking at a communications mistake? Are we looking at a policy mistake? What do we think were the motives behind the decision adopted yesterday by the FOMC?
Well, it's a really interesting question. I think we're yet to know what the drivers were behind that decision. Either way, I don't think it's particularly great news. I think the normalization of interest rates over time, because we were recovering to a growth phase, was a natural process that markets were hoping for, although clearly the last 3 months have been a bit volatile. But what is the Fed saying by removing this tapering announcement? Firstly, yes, you're right, it is a communication mistake. Back in May, they were saying, tapering would happen. But they did say tapering would happen dependent on growth. Now, the fact that tapering isn't going to happen, does that mean there's now no growth? So, that would be worrying in itself, and we'd have to look at the data in the next month or 2 months to see if the Fed knows more than we do currently. The alternative is, of course, is that maybe they're worried about growth because, interest rates have spiked, yield curves have spiked, and they're worried about the implications for the housing market, etc., if that continues. Now, if this announcement is down to trying to manipulate the yield curves and manipulate interest rates and the market itself, then I think that's a pretty worrying trend.
Okay. As well, you were explaining to me earlier that almost independently of what the central bank does, the situation, the fundamental backdrop for the U.S. economy is quite negative. There hasn't been a cleansing process, and they've bet the house, literally, on QE.
Well, this is it. Back in 2007 and 8, when we started on this process, clearly what should have happened, we should have had a cleansing process whereby bad companies went bust and the good companies survived. But that never happened. And what we've done by having a zero interest rate policy effectively is allow those good companies to survive. And the issues with the levels of debt and the fiscal deficit in the US still haven't been addressed. So, to my mind, the recovery is still a little shaky. It was beginning to show signs. But what now is the direction of the US economy? Is it weaker? Is that why we haven't tapered? Or is there something else we don't know about? It's a very surprising decision, I'd say.
Okay. Going into more specific detail as far as the fund which you manage, what will be your bias when positioning the fund going forward, both as a result of the FOMC meeting result, but also in terms of your regional allocation, which is Asia Pacific, and there as well, we've had China, Japan, particularly Japan, I guess you could say as well, relying too heavily on QE. In China, it's just more traditional stimulus measures, but again, there might be some structural reform issues.
Well, I mean, we are an income fund, so value and income, it means quite a lot to us. And for the last 3.5 years, we've had a great time of it. Zero interest rates, low growth, and people looking for yield has been a great story for income. Obviously, the last 3 months, when we were thinking we were going to return to a more growth-orientated strategy, that's been a bit volatile for the portfolio. But I think from here, I think we retain exactly, I still believe that even if the US is growing, interest rates won't go back to levels we've seen in the past. Okay. So the need for yield and investors' need for yield will still be there. The other thing is, of course, is that what dividend investors want is growth over time, and that's what Asia gives income investors compared to people in the West.
So medium term, you are still confident in China? Because up until recently, May, now the pessimism has withdrawn a little bit, but in May there was a little bit of a growth scare as far as China is concerned.
Well, there's always a growth scare with China. It's either a growth scare on the positive or the negative. We swing between these wild moods in sentiment. Actually, I think the Chinese have done a pretty good job of managing a pretty stable environment over the last 5 years. Okay. And I've actually been quite encouraged with some of the announcements that have come out of the new government in terms of reform, in terms of what levels of growth are needed to sustain the economy and the reforms that are going to take place within that economy. So in an environment where we are a little apprehensive about global growth, I still think China offers more stability than most.
Okay, fantastic. India, it's a country that's been in the news lately. Tomorrow we have a policy meeting from the RBI. What do you expect from that policy meeting? The new central bank governor, how do you think he will do things? Do you think he will be effective as far as his track record? His background is the IMF, so he ought to be qualified.
I mean, all these things suggest that India is moving in the right direction. Firstly, we're getting a government and a central bank. Firstly, with experience behind it. So if anyone's going to get it right, then they should. The problem is, I think their hands are tied. We have structural issues in India, both with the current account deficit, the fiscal deficits, and the fact that a lot of these deficits are funded by foreign flow. So when you get these announcements about liquidity globally, you saw a big outflow from India, which put the currency under pressure. Now the currency under pressure also means that inflation moves higher, which gives them very little room in terms of interest rates. And it's difficult to see how a new bank of an RBI governor is really going to make a big difference. I think it's the structural issues in India which need addressing, and not necessarily the cyclical.
If you had to choose one market in the region, which would be your favorite market?
China.
China, okay. Could I ask you for 3 reasons why?
Yep. It's cheap. The market trades on about 8.5 times earnings against the average for the region of about 11.5 to 12. I think in this volatile period, I suspect volatility comes back. That this is the economy which is most likely to deliver sustainable growth. And within that, we're quite optimistic on the reforms that are likely to come out at the Central Committee meeting, which is in November, both in terms of reforms of the social sector, fiscal reforms in terms of financing local government, other things in terms of tax, welfare, etc. So we think we can get exposure to that with some pretty interesting companies.
Okay, and again, if I ask you for an example, the best example in your opinion, of the type of stock that you would invest in, that investors might want to look at, what might that be?
Well, there's lots actually, but if you push me to go for one, then we've recently been. Well, I'll talk about 2. There's one called Sinopec Engineering, which is the engineering arm of the great Chinese oil conglomerate Sinopec, and the environmental issues in China are going to be a challenge. So I think anything exposed to improving the environment is good. And Sinopec is developing or develops a process which converts coal to gas as a feedstock for power generation.
And power generation in China is extremely reliant on coal.
Absolutely. Well, China's short on virtually every commodity in the world with the exception of coal, which unfortunately happens to be the dirtiest commodity.
They have the largest stocks in the world?
Sorry?
They have the largest stocks of coal in the world?
They have massive stocks of coal. So, trying to make that whole power generation process cleaner is this company's kind of on the forefront of that.
Okay, fantastic. And the other company which you liked?
Yeah, we also like. We think the Chinese adoption of internet, is a given. We've seen it on PCs. It's moving towards tablet and smartphones, and it's not just Facebook equivalents, but it's gaming especially. We've been interested in a company called Giant Interactive, which is a US listed company, develops games which we should be online, but now moving towards mobile apps and gaming.
They develop games for on a global scale or China?
China, purely China. So it's kind of role model games and Call of Duty equivalent kind of games, but for very much directed towards Chinese.
What stage of development is that market in China? In the West, it's a huge market.
Yeah. Well, the difference is that in the West, it's mainly on consoles. So it's Xbox and PlayStation. That's not a concept that really works in China. It's never been like that. It's always been people go down to internet cafes, get online, and play with these role model games with their friends in other towns, etc., etc.
Reports on it.
Yeah. So, and then as that moves now to other technologies, as the networks get better to support data gaming apps, then that'll move, we think, as penetration. So the potential for this is massive.
Extremely interesting. Unfortunately, that is all the time that we have for today. As you told me before the meeting, you did not have too long for this interview. We do hope that you'll be able to stay longer with us next time.
It's a pleasure.
Mike Kerley, Director of Pan-Asian Equities at Henderson Global Investors. Thank you very much for your time.
Thank you.
And that's all from us here at Digital Look TV for today. Thank you again for joining us. Until next time.